has become very quiet now. Of course, it's all over the place and the market has picked up from the lows, but now it's in flat terrain and the mid-cap index is still under pressure. This is a good time to take a step back and to listen into some of the biggest FII voices. Earlier today, we spoke exclusively with Hugh, the head of Asia Pacific at Aberdeen Standard Investments, on how he's reading the coronavirus contagion. He says that they're seeing some cash withdrawals from short-term investors. He adds that the earnings growth in India continues to be below expectations. Take a look.
At the moment, we're certainly not seeing money coming in the door. Obviously, while markets are going through the volatility they're going through, many investors, our own included, are sitting on the sidelines. So we're not seeing in our open-ended mutual funds, we're not seeing cash rushing into the market at the moment. I mean, if anything, depending on the fund, we're seeing investors shorter term more likely to withdraw money, which typically happens after markets have fallen, much the same as typically after markets have risen. You tend to have money coming in the door. In a sense, from an investor's point of view, such as ourselves, the worst possible timing. So for us, it's more a matter of sitting on the funds we have, either rejigging our portfolios, so adding to areas where we think have been oversold, maybe taking a bit of money out of areas that have remained very resilient. We do have a bit of cash in funds, but typically that's a residual amount of 1 or 2% for eventualities. And at the moment, by and large, we're sitting on that cash, particularly in open-ended funds, just in case there are redemptions.
Do you intend to raise cash levels, or you think this is a market in which you will remain largely fully invested, except for that 1 or 2% cash that you spoke about? And your views on a market like India?
Well, we do typically remain largely invested. We don't take major cash decisions when people have decided to go into a dedicated India fund, but partially because you never know whether they might have positions against that themselves. So we run our portfolios by and large fully invested. We do keep a bit of cash for redemptions, so that 1 or 2%. I think we get, as investors, we get a lot keener when prices go down. I know it sounds rather counterintuitive, but the cheaper good companies get, the better. But at times, it feels like sort of catching a falling knife. And one of our concerns that we've expressed, certainly over the last few years, has simply been that India is one of the more expensive markets, and that the growth has not been coming through as expected. And that continues to be the case in India's case. Economic growth hasn't been as strong as we were hoping for, and earnings growth hasn't been as strong as we were hoping for.
Now, with this whole Yes Bank debacle, do you think that financials could go through a period of pain, and would you reduce your exposure to this sector?
I think broadly financials could go through pain, but of course it's going to be certain financials which need to go through the pain. One of the issues, again specific to India, has been that the financial sector is a bit of a mess and really hasn't been cleaned up as it should have been. And the silver lining in the dark cloud of Yes Bank is that things are being cleared up. As far as we're concerned, we've stuck with the quality end of the spectrum, so the HDFCs, the Kotaks. The issue there then is one of valuation, and could we see the valuation come down? Yes, of course, that is possible. But are we tempted to go into the lower quality end of the financial market? Still not, and we prefer sticking with our core holdings in the good long-term winners.
Well, the other thing I wanted to ask you was your view on HDFC Bank. I am personally surprised that that stock is under pressure because even their last results were excellent. The management change, impending management change may be a worry. What's yours?
Our basic worry with HDFC Bank and even HDFC parent is valuation. So we dearly love these companies to be a lot cheaper. Yes, there's management change happening throughout the HDFC group, and I think they've got a good batch of upcoming leaders. So that doesn't worry us so much, but valuations do worry us.
This whole coronavirus scare, because of a coordinated supply and demand collapse, do you think that could lead to the start of a bear market in in global equities?
Yes, indeed it could, although having interest rates at zero, money being pumped into the system, big spending projects could keep markets up, and that's what's intended. But the major concern is that we do have a pandemic. Well, I mean, I think we do have a pandemic already, of course, and it's spreading by and large out of control, and that can really hit economic activity and is really hitting economic activity. So they're all the hallmarks of a bear market. But then what do you do with your money? Interest rates at zero. Do you keep it in equities yielding 2, 3, 4%? Maybe you do, and maybe we'll all be surprised.
Well, let's get to another CNBC-TV18 exclusive then. We learned from government sources that they will be watching out for the real impact of the coronavirus in the first quarter of next fiscal. They also add that an intra-MPC rate cut is ideal. Sapna Das, she's bringing us all these details. Sapna, tell us, what are you picking up?
Hi. So basically, different views coming in from, various government quarters, just talking about the current scenario and how it's panning out or likely to pan out. So one aspect could be the fact that, maybe the disruption that we are seeing due to coronavirus at the moment, some spillover effect is likely in the first quarter of the new financial year. I mean, obviously, we are in the last month of the financial year. So some spillover impact is likely. Also, in terms of the overall inflation scenario, I mean, this is likely to turn extremely benign. Basically, inflation has already come off, post that hike in onion prices that we saw and CPI shooting through. But, that trend is likely to come off very substantially, and around 4.5% to 4.67 odd percent can be the possible range if you may look at, by the time the first quarter of the new financial year is over, somewhere around in that range. Keeping all of these aspects in mind, possibly, and nothing very surprising here, but there could be a scope for lower interest rates. Ideally, maybe some decision should be taken between the MPC meetings. Could be one side of the view. And in terms of the range, of course, it can be between 25 to 50 basis points. But that, again, is completely a call of the Reserve Bank of India. Last but not the least, looking at this overall environment, there has been talk about rejigging small savings rates. FY19, more or less, the government has held on to them. So looking at the overall movement of bond yields and the way the interest rates are moving, possibly some downward tweaking is also possible on that front. That's not ruled out at all.
Okay, Sapna, thanks a lot for that. So that's an exclusive story coming to you. But there could be an intra-policy MPC cut as well. Let's take a quick break on that note. On the other side, we'll get back to technicals. Prakash Gaba will join in with some trading strategies. Do stay with us.